Recently, due to ongoing shifts in tariff policies, the narrative keeps changing fast. As a result, the US market conditions are getting more uncertain. You can see this clearly from the three major indexes. They reflect the current state of the market. The trend looks quite indecisive. Just look at the Dow Jones. It's been trading in a narrow range here. The movement has been very limited. It's been stuck like this for days, for 5 sessions now. And here's what's interesting. What is it? 3 days in a row on the candlestick chart, we're seeing long lower shadows forming. 3 long-legged candlesticks in a row. This pattern suggests there is strong support below. It shows buyers are stepping in at the lows. If you can't see it clearly just from candlesticks alone, let's switch to the intraday chart. That gives you a much clearer view. Why do we see 3 long lower shadows on the candlestick chart? Take a look at the intraday chart. This is what happened over the past 3 days. Each time when the index hit this level, around 41,850, there was a clear rebound, and the strength of each rebound was very obvious. So every time it dropped near 41,850, you could see strong buying pressure. Funds stepped in and pushed the prices up. That's why we saw the bounce. So on the candlestick chart, we can clearly see those long shadows, 3 long lower wicks in a row. This indicates strong support underneath. It means capital is stepping in at the bottom, but does that mean a rally is coming? Not necessarily. And that is exactly why the market feels so uncertain. There's resistance above, even with buyers below. Still, there's also clear pressure from the upper range. Right around here, every time the index rises, it pulls back again. Especially in the last session, there was a noticeable spike in volume. Volume increased, right? But there's still no clear sign that it can break through the upper resistance level. Especially this week, on the first trading day, all three major indexes saw low volume. The drop in volume was quite significant. So what can we clearly see? On the first trading day of the week, the trading volume shrank noticeably. It dropped nearly half of the previous session. Look at this volume bar. See this one here? Compared to the last trading day, it's clearly down by half. That's a sharp decline, and right at the start of the new week. That drop came on day one. What does that suggest? It means the market is highly cautious. There's a strong wait-and-see attitude. If there were real confidence, we'd see strong action on Monday. That would have boosted market sentiment early, built some confidence since more trading days are still ahead. But instead, Monday didn't show much strength. Even though there was a bounce when the index touched the support, it did rally upward, but during that rally, volume didn't pick up much at all. There was no volume spike, which shows us market participation was weak. Why didn't they participate? It shows that this week, market sentiment is still weak. There were no clear bullish signals to give investors real confidence. On Monday, the market failed to launch a strong move. It didn't lay a solid base for the rest of the week. In short, there was no clear optimism in the market. It just wasn't there. Even though we saw a V-shaped bounce, it dropped first then quickly recovered, forming that V pattern. Still, it didn't really improve market sentiment much because volume stayed low. There was no follow-through. What's missing? No follow-up buy interest. So what does it mean? It means they're hesitant. Why hesitant? Because they don't see a strong signal from the broader trend. No reason to act just yet. So above there's still clear resistance. That's why we shouldn't assume just from a brief intraday signal that the market is turning bullish. Each time it reaches this level, it bounces back. There's always a rebound, and it's very obvious. The upward move is strong. It's a clear reaction. But above, around this area, there's also resistance. It's a resistance zone. Right here, we can see it clearly on the intraday chart. You can feel it, right? It's not just the Dow Jones and Nasdaq. Nasdaq and S&P 500 show the same pattern. There is support from buyers below, propping up the market, but there is resistance above. So what forms? A very narrow trading range. But it won't stay like this forever. Why not? Because if we look at the 1-hour time frame, we can already see signs of a shift. At this level, what's happening? A possible breakout is forming. In the short term, it's shaping into a small head and shoulders top. If that head and shoulders pattern breaks down, then the index could fall further. If it chooses to go down, the market will likely follow, but at this moment, it hasn't made a move yet, no breakdown so far, so it's in a very uncertain spot. So why the market staying on the sidelines? Because on the 1-hour chart, the head and shoulders pattern is clearly forming, but the neckline hasn't been broken yet, so traders remain hesitant. What if the market breaks down? If it moves lower, the pullback could be quite sharp. That's why this level feels awkward. It's a tough spot. Can it break higher? Maybe, but there's no volume support. No strong signals to trigger buying, and to move lower, support still holds. So overall, it's a very indecisive zone. So what's likely ahead? Most likely, the market will continue to trade sideways. Sideways movement is still the base case. So with the market stuck in this indecision, many individual stocks are also moving sideways, especially the tech giants. They are hit hardest. Why? Because of tariffs. But are there companies not affected by tariffs? Yes, some are. Some are not impacted by tariff policies. In fact, for them, tariffs could be a tailwind. Have you noticed? Take Microsoft, for example. It hasn't been hit by tariffs. In fact, during this sector pullback, it actually rallied while the rest of the market was correcting. Microsoft moved up against the trend while other tech names suffered under tariff news. Microsoft stood out by moving higher. So why is that? That's what market's wondering. Why is Microsoft one of the big seven, unafraid of tariffs? Let's break it down briefly today. Why is it unaffected? It might even be a safe haven. Why is that? Because Microsoft's business model is different. Their operations are structured differently. What does Microsoft mainly sell? Digital products and services. Because of the nature of its business, its structure, the impact from tariffs is minimal. Its advantage is that Microsoft doesn't rely on selling physical goods. It's not focused on consumer hardware, so it's barely affected by tariffs. It's not a manufacturing company. It doesn't sell physical, tangible products, right? Microsoft sells software. It provides services. No tariffs involved, no shipping needed, right? That's a core difference. So in this tariff-driven storm, Microsoft and other software stocks have become safe havens. Their unique model stands out. This uniqueness makes them attractive in volatile times, even more appealing in a downturn. So naturally, they are favored over hardware stocks. Software firms like Microsoft, they sell digital products. No shipping is required. Tariffs won't really touch them. No major impact from trade barriers. Even when tariffs were announced, emotionally markets were shaken. Some stocks got dumped. But Microsoft quickly rebounded. Why? Because smart money caught on fast. Those who saw it early experienced the rational investors. They realized while tariffs hurt many companies, software firms are not shipping goods, no physical transport involved, no supply chain risk. So the tariff impact is very limited. That's why they become safe haven assets. When tariffs were officially announced at that very moment, market sentiment was broadly negative. Many of these stocks were oversold, which gave smart money a solid buying opportunity. Once the market calmed down, those early informed investors at that moment found some great setups. While other sectors struggled under tariffs, these software leaders stood out with strong performance. So if you look at Microsoft's stock price, it's already reached its previous high. It's approaching a key resistance level, a very critical one, because it's testing that prior peak, and at previous highs, there's usually pressure. So can Microsoft keep rising? Will the rally continue from here? As of now, Microsoft is barely affected by tariffs, but does that mean its strength will continue? It's right at the prior high where resistance is clearly strong, and on shorter time frames, we can also see it's approaching a breakout point. A tightening irregular triangle is forming. The candlesticks show this pattern has already begun to take shape. So what does that tell us? It's near a breakout. Once the triangle nears its end, there's potential for a move. But will it break upward or downward? Let's analyze it. Especially when the stock hits strong resistance, you should never go long right at resistance. At that point, avoid entering long trades. Wait for confirmation. Simple strategy. When it hits resistance, just wait. Be patient. Don't jump in without clear setup, because right now, the market hasn't made a decisive move yet. No clear direction has been shown. It's already met resistance above. If that resistance doesn't break, there may not be much upside. When resistance is clear, avoid going long. It's just like if you're at clear support, don't short into it either. So at this level, the best move is to wait and observe. Although Microsoft's fundamentals look solid, everything points to strength. We could call this bullish setup. It's barely impacted by tariffs. The effect is minimal, so operations remain unaffected. At this stage, what does that mean? Investors will focus more on companies shielded from tariffs. These become safe havens, and safe havens attract capital. That's the underlying logic. So from this view, it's fair to consider this a positive. But technically speaking, we also see Microsoft showing strength. This latest rally has been solid. The price action is strong. So why are we cautious? Because it's now testing previous highs. That resistance is obvious. So until that resistance is clearly broken, what should we do? Stay patient. Unless it breaks through with strength, then pulls back to test the support and holds. That's your entry. That becomes a buy point. Fundamentally, we're already bullish. If technicals align and the price breaks past the old high, clearing resistance, then the upside opens up. The safest buy point is after the first pullback post-breakout. Watch that first dip. If it holds support, that's a good setup. And right now, as you can see, can it break through this level? Technically speaking, there's no strong volume yet, no real breakout strength. And if we look at MACD, this momentum indicator, we can see a bearish crossover on the daily chart. So at this level, there's still some downside pressure. This bearish momentum right here is forming a layer of resistance, so we need to wait for a clean breakout, wait for confirmation of strength, a breakout supported by volume, then look for the pullback setup. The safer buy zone is right there. This concludes a brief analysis of Microsoft's outlook. If you're bullish on Microsoft, then timing your entry is key. Make sure you pick the right moment. Don't buy right as it tests resistance. That's risky. If the breakout fails, what happens? It pulls back. No breakout means downside risk. If it keeps falling at resistance, it will likely fall. If you have your own view on Microsoft, feel free to share it. Leave a comment below. Let's discuss it together.